Tom Lee said on Friday that there is a high likelihood a tariff solution is coming. He said that stocks have overreacted to the downside and history suggests a larger rally could be coming. Take a listen, but I will say I disagree with this, and I'll tell you why after.
One of your next guests says the markets will find their footing before April 2nd, when the reciprocal tariffs, at least for now, are set to take effect. Joining us now for more is Tom Lee. He is the head of research and founder of Fundstrat, also a CNBC contributor. Also joining us, Nancy Tangler, Laffer Tangler Investments CIO and CEO. Tom, listen, I understand it's a different White House. Every day we get a market-moving headline. A lot of people, I think, honestly, I'm just going to say it, they don't want to be neutral. They don't want to be data-driven. They want to be angry. I get that. But history says that markets will recover, right?
Yes, they've recovered every time. One thing we have to keep in mind is when markets fall this quickly from a 52-week high, I mean, just remember, less than a month ago, we were at all-time highs. That is a market pricing in a crisis. I'd say we're almost 50% pricing in a recession, and we're assuming there's no Fed put. Now, the Fed is in a position to cut rates. That really should mitigate the downside. And I do think two other things that investors have to keep in mind, because many people just want to get out until April 2nd, is number one, I do think there's a very high probability that a tariff solution happens before the next 3 weeks happens. And it's simple to see because China, Europe, Canada, Mexico, since April 18th, all of those countries have outperformed the U.S. I don't think that markets are that blind to say if Canada and Mexico are about to have a recession, they should outperform the U.S. And I think the second thing people should keep in mind is that when you have a global crisis brewing, and we highlighted like the 1962 Cuban Missile Crisis, that was a 12-day crisis, but the markets bottomed 7 days into the crisis. 5 days before that crisis ended, the market was already recovered 2/3 of the losses.
Now, I strongly disagree with what Tom Lee says there. Markets are nowhere close to pricing in a 50% chance of a recession. Like, you're a long shot away from that, and I'll prove it to you. So I did this research post on X. Grok helped a lot with this, but this is the average SPY EPS fall during recession years, okay? You have all of these drops, 54%, 57%, 10, 12, 14, 15, blah, blah, blah. The average during a recession is a negative 15% EPS growth. So it looks like 2024 EPS, while we're still getting through the last bit of earnings season, is going to be around $236.92. That's kind of the average expectation at this point. If we were to theoretically go into a recession this year and you shave off 15% of that EPS growth, you're going to look at $201.39 for 2025 EPS. Recession multiples bottom between 13 and 17.3 on average. With a 13 PE on $201.92, you're looking at a bear case of $261.80 on the SPY. That is a 52.5% drop from current prices. So like a 63% drop from all-time highs. On the high side of 17x multiple, that would be $342.30 on the SPY. That's a roughly 39% drop from current prices. So almost a 50% drop from all-time highs. At the midpoint of 15.15x PE, that would be $305.90 on the SPY, a potential 45.5% decline. Now, part of the issue is with this, Wall Street is still expecting between 11 and 15% EPS growth this year. So what I've actually think has happened is instead of expecting, negative EPS growth this year, we're seeing the markets price in less EPS growth, right? So if we started this year, as you can see, FactSet Analyst Consensus projects 2025 EPS growth rate of 14.8%. Goldman Sachs is expecting an 11% growth rate for EPS. You're probably at like a 8% EPS growth rate that Wall Street's actually pricing for right now. Okay, it's almost impossible to figure that out distinctly, definitively, but that's my best guess. The average EPS growth since 2000 on a compound annual growth rate from 2000 to 2024 is approximately 5.25% per year. So you're still likely pricing in a better earnings environment than historically we've seen over the last 25 years. So we are nowhere close to pricing in a recession. Like nowhere even remotely close. If the average EPS drop is negative 15%, and we started this year between 11 and 15% expected EPS growth, that's why you've seen such an aggressive sell-off from the highs. It's because people all of a sudden have to, come to terms with maybe our EPS targets are way off. And if those EPS targets are way off, that means markets are actually a lot more expensive than we priced for. Kind of reverse engineer this. So I gave you the bottom line, if we go into recession, markets are going to fall a lot. That's the bottom line. And again, I disagree with Tom Lee. Markets are not priced for a recession. It's the rapid repricing we have seen of EPS targets, but we are nowhere close to pricing in like a negative EPS year for markets, when in all actuality, that could be a very real outcome for this year. Let me tell you why. Tariffs. Consumers are sick of inflation. Tariffs are a tax that will not be able to be passed on to those consumers. Company margins will suffer, and that is not good for markets. So recession or not, tariffs are not good for the stock market. And really the way I look at this is companies will not be able to pass on cost from tariffs. They can try, but what's going to happen is people are going to cut back. They're not going to buy as much. And then those companies are going to be in an even worse spot as their factories idle. Okay, so what do companies really have as a choice here? Well, they can eat the margin hit, or they can fire people and try to become more efficient with less employees to make up that margin difference internally. Okay, that's the more likely, path forward with tariffs. Now, the economy these days is mostly services and people spending money. About 70%, a little bit more than that, 73% of GDP is really just people spending money. Okay, a lot of that is on services, some of which is on goods. Recessions are caused by abrupt slowdowns in consumer spending. These days, it's different. That's why we didn't go into a recession because the Fed raised rates. Only 20% of the economy is manufacturing, a heavily intensive capital, business, right? Or businesses. The Fed doesn't cause recessions anymore. What causes recessions are consumers just slowing down their pace of spending money. And that usually only happens from a shock event. The economy is very well diversified and good at absorbing change, but not quickly. So the bigger the change, the faster the change, the bigger the shock event. And Doge and tariff uncertainties are the catalyst. Tariff uncertainty is causing business investment to essentially grind to a halt. Short term, likely hiring will follow suit. Everyone knew about this, but nobody thought Trump was serious. Now we know he's serious. And really, I think the biggest sign of a potential recession is Walmart and retailers, okay? I've talked about this for a long time here on this channel. The moment you want to really start considering the recession risk is when Walmart and your retailers start to tell you there's a recession, issue, okay? And start, cutting guidance and citing weakness in the consumer. Here's a list of the companies that have, in this earnings season, expressed concern about the consumer, suggesting consumers are slowing down. Target cited, quote, meaningful pressure from tariffs and weaker demand. CFO Jim Lee highlighted significant consumer uncertainty. Walmart, they projected a modest 3 to 4% sales growth in 2025, well below the street's expectation, signaling tariff concerns and softening consumer confidence despite a strong 2024. Abercrombie and Fitch, they also guided lower. Best Buy, they said there is declining demand for electronics and discretionary items. Another warning. Macy's, They flagged weak consumer spending and expectations for 2025, with holiday sales and profits slipping amid a cautious shopper base. Home Depot said that the housing market is not recovering and there will be broader spending weakness continuing. TJX expressed concerns about weakening consumer confidence impacting future sales, despite they actually did pretty well. Kohl's, they cut earnings forecasts, citing tariff pressures and reduced demand for apparel and discretionary goods. Dollar General noted struggling shoppers shifting to essentials, reflecting broader spending caution across income levels. Dollar General was really interesting because Dollar General is, a retailer that really caters to lower income consumers, middle, lower income consumers, average people, if you will. And Dollar General says, even in the last couple of weeks, since really the start of 2025, you've seen this trade down really accelerating. And the best way to describe what a trade down is, imagine if you buy, trash bags, right? A name brand trash bags, you love them. They're the ones that smell good, Instead of buying that $8 bag of trash bags, you're buying the $4 store brand. Okay, that's a trade down. Or instead of buying these Black Forest, fruit snacks, which have no food dyes, bunch of vitamins, all good stuff, right? Relative to other alternatives, but are $6 for a box. Instead of buying, now you're gonna go out and buy the $3 box that is worse for you, okay? Some people are going to do that. Some people are not. If you're like me, you're not going to put your health before money. But, especially when the kids are eating these. Topic for another video. That's what a trade down is. And that is happening across income demographics. People are slowing down. They're grinding to a halt. Ross, they signaled a tougher consumer environment. Okay. Delta Airlines highlighted a drop in vacation bookings, aligning with Conference Board data showing vacation plans at pandemic lows. Starbucks noted softer U.S. traffic in Q1 2025 projections, attributing it to a inflation-weary consumer cutting discretionary spending like coffee runs. McDonald's signaled pressure from lower-income consumers trading down or eating at home, with value menu reliance growing amid inflation. Ford warned of softening demand for big-ticket items like vehicles tied to interest rates and consumer caution, though not as explicit as retailers. Lowe's echoed Home Depot's caution, projecting a 2 to 4% sales decline in 2025 due to weak housing activity and discretionary spending pullbacks. Now, these are just the biggest companies, right? There is many other companies that are also giving you similar warnings, but these are the ones that are really like bellwethers to the economy, if you will. Now, I think the other aspect of the shock event that we're currently seeing in the economy that's causing consumers to pull back their spending is the massive amount of government employment, okay? With new headlines coming out daily or weekly that a new department's going to be completely fired or another round of layoffs from the government. That has people on edge. Now, if you look at state and federal level, you're looking at 22.6 million people that are directly employed by government entities. To some extent, state workers as well are probably feeling a little nervous about their job security. I don't know how, nervous or how you'd necessarily quantify that. Now, there's 3 million government employees, like federal employees. Thank you. And on top of that, there's another 10 million employees that work at businesses that get all of their income from government contracts, like construction companies, specific subsidies, okay? So there's really about 13 million people that work for the federal government that are nervous right now. And I've met some of them. And that's where you're getting that sharp pullback in consumer spending behaviors. Now, there's 168 million working people in this country. If you consider 13 million people are nervous about job security, that alone is 8% of the working population. That's a lot. That, I think, can be classified as a shock event. Now you also have this University of Michigan data and this great chart from Renaissance Macro Research that says the big news in the UMich data was not inflation expectations. Look at what people are saying about the jobs market. Expected change in unemployment worse since the 2008 recession. No one is asking for a raise in this environment. You could see these numbers roughly align with each other, okay? And especially like the red line tends to lead the gray line, right? The gray line is the non-farm payrolls, and the red line is the UMich expected change in unemployment during the next year. When these things move, they tend, when one moves, the other tends to move as well. Okay, just very rare instances where you see one of these move and the other one does not at least follow suit to some degree. Okay, well, it plummeted. Okay, it absolutely cratered to levels you have not seen since like deep recession territory. Okay, this is not a great sign because odds are the labor reports are going to follow suit and look something like this. You're going to see labor markets start to fall off a cliff. Okay, a lot of that has to do with Doge, tariff uncertainties, right? You get it. Okay. It's not going to be a good thing for markets. And with the threat of inflation via tariffs, the Fed's not going to be super quick to rush out and save the markets. That's where I, again, disagree with someone like Tom Lee that says the Fed's just going to rush in and save the day. I don't think so. I don't think the Fed, is going to be that quick. Now, if it looks like we are guaranteed or dead set to go into recession, then yeah, the Fed's going to try to come in and save the day. But at that point, by the time the government data shows that we're looking like we're going into recession, it's going to be too late. It's going to be too late. Too late to save the markets. Also pretty interesting on X, Lawrence H. Summers, you probably never heard of him. I never heard of him before, in all fairness. I stumbled across this post. He is a university professor and president at Harvard. He says, he was the Secretary of Treasury for President Clinton and director of the NEC for President Obama. So he was basically the Scott Bessent for Clinton. Okay, Scott Bessent is already talking about a recession that's coming, a quote-unquote detox and transition period, okay? So if you don't believe what I'm saying or some of the data coming out, like maybe you believe Trump, maybe you believe Bessent, that is literally telling you we're going into a recession, okay? Lawrence H. Summers says, I am convinced there is nearly a 50% chance of a recession, and maybe even far greater risk of recession, unless the current policy approach of tariff threats lurched is altered. CEOs, consumers, and markets are all looking for a stagflation scenario. Now, stagflation, obviously not great at all. That is when you go into a low growth environment or recessionary environment, but you still have inflation. I don't think that's what we're going to get. I think if we go into a recession, you could actually see deflation, which is a really bad setup. Like deflation's even worse than stagflation. Okay. But I found that interesting that he's so confident to say this. And he was the Scott Bessent, if you will, during the Clinton administration. And I think it highlights like the government knows what they're doing. I think they're doing this on purpose. They're trying to get rates lower. They're trying to kill inflation. The best way to do that is with a slowing economy. Historically, you have to have a slowing economy or a recession to ultimately kill inflation and to lower interest rates after a big rise in inflation. That's the idea. If you do it now in the beginning of the term, you can blame it on Biden. You get back to business as usual in 2026, 27, 28. That, to me, seems like the approach that they are taking. Now, as I explained in the last video, this is likely the start of a bear market bounce. There's not a lot of conviction in this bounce that we've seen on Friday. And there was very low volume, the lowest volume in 12 days. That's typically not a sign of a durable bottom. Now, anything can happen though. And even though it looks like recession odds are a lot higher than how markets are pricing them, and the downside could be excessive if we had an average recession with an average drawdown of 15% in EPS with a pullback in multiples between 13 and 17. I mean, you're looking at a disaster coming ahead for markets. But I can tell you the best way to position your portfolio. And I think this is something that a lot of people miss out on and often cause them to make big mistakes that they regret. Because, you know, a lot of people assume if you're bearish, if you think a recession's coming or you think odds of recession are high, that you should sell everything. And that is not the right approach, okay? And then if you're someone that thinks that there's no chance of a recession, you buy the dip nonstop, every dip, every day the markets are red. And then if it keeps going, you're not in an ultimate, you know, position to capitalize on markets at much lower prices, right? You don't have to be all in one direction or the other, right? Even if you think there's a huge chance of a recession, it doesn't mean you sell everything. Because what if you're wrong? And then you don't get back in. Next thing you know, markets are at new all-time highs, breaking out, and you're not exposed to equities, okay? So the best thing to do, I think, in my opinion, again, we talked about this a little bit in the last video, is be positioned for both sides, okay? I don't sell stocks unless the businesses get worse or change. Just because there could be a recession coming is not a reason to sell your portfolio. Because what if a recession does not come? You want to be in a position to take advantage of a, recession, right? But you don't want to miss it if we don't go into recession. So the best way I found to do that is to stay invested, but your extra cash that you're now accumulating and saving, don't be so quick to buy the dips. Okay? It's not financial advice. It's not a recommendation. That's what I'm doing. I'm not putting new money to work right now. I'm saving that in cash. Worst thing possible that could happen there is we don't go into recession, markets recover, and you have some extra cash. Next time you get a really good deal, stock sells off big on earnings, big overreaction, Tesla's down even further, you can plow that money back to work. And again, Tesla's down 50%. Even if the stock recovered to 300 or 350, that'd still be down over $100 per share from all-time highs. Even if you had some extra cash and could confirm we're not going into a recession, that's still a pretty good price, in my opinion, long-term to buy a stock like Tesla. So that's a way to put yourself in a position to benefit no matter what happens. Now, there's also ways to hedge your positions as well, to hedge your portfolios. That's what I'm currently doing in bonds. If you guys want to see the trades that I am making in the bonds market, check out that link down below in the description of this video. It's not financial advice, just really what I'm doing. Come, talk to us, get involved with the community. We have a newswire over there, source great information, all of it. And again, I do like the risk reward in Tesla. If we do go into recession, if it's a bad recession, Tesla's going to fall to that $100 level, maybe $120 level, maybe $80 level, something like that. But if we don't go into recession, Tesla could double, triple, 4x from here by the end of the year, right? If all things go well, Robotaxi, Optimus, all of that. Lower price Tesla, vehicles. I like that risk reward. Because even if you look at the SPY right now, what's your upside from here? 10, 15, 20% max by the end of this year if things go perfectly? What's the potential downside if things do not go perfectly? 40% from here? I don't like that risk reward. It doesn't make sense to me from a headline market perspective. And again, the bounce on Friday, yeah, and it didn't look that good when you look at the volume, considering it was almost half of the volume you've seen on some of the, heavily traded days, like on March 4th or like on March 10th, okay? So I would just be a little bit careful here. Next week, we have massive catalysts. Starting off on Monday, you have retail sales. That's really going to solidify whether or not we are going into a larger, consumer pullback. Based on earnings we've seen from retailers, you're probably going to get a pretty ugly retail sales report on Friday. Last month, it was down negative 0.9%. Last time it was this bad was 2022, right? And early March of 2023, when you had the banking crisis and people thought there was a chance that could turn into a recession. If you fall again into negative territory, that's going to be a big problem, because it really doesn't happen all too often where you get, more than one like negative number. Normally it's one negative number and done. Last time you had two negative numbers was November, December of 2022, okay, and February, March of 2023. Last time you really had growth concerns. Now, on Tuesday, you're going to get building permits and housing starts, some secondary data, industrial production, all of that. So you will get a new GDP update from the Atlanta Fed. On Wednesday, you get Fed Jerome Powell, the summary of economic projections. They're going to tell you what they think the neutral rate is, where they think inflation is going to be by the end of this year, where they think unemployment is going to be, where they think GDP is going to be this year and next year in 2027. And that's really the long run projections. And this will move around expectations a lot. If the Fed is getting more worried about the economy, you're going to know that. And during the conference, the press conference, Jerome Powell is going to have a lot of tough questions about a potential recession, consumers slowing down. And, you know, every word that he says is really latched onto. On Thursday, you're going to have existing home sales, some other, you know, smaller data sets. On Friday, you have Fed Williams that speaks, but not too much. So really starting off Monday, it's guns a-blazing, huge economic data. So let me know what you think about all of this down below in the comment section. Do you think this is a bottom, or do you think markets have to fall further? And again, as I've said in previous videos, once we get down to this 500-day moving average around 497, call it 500 on the SPY, I think the risk reward looks a lot better because markets would be down about 19% at that point. At that point, I think you're pricing in about a 50% chance of a recession. And that's where the odds become a lot better that if we don't have a recession, you're going to get some really good gains from that bottom. If we did have a recession, you know, you've already priced in a good chunk of that, so the downside doesn't look as excessive. So that's just my thoughts. Let me know what you guys think down below in the comment section. Have a great rest of your day, and I will see you in the next one.